So far today, you've heard all about the differences between uplisting and IPOs and various different elements of being a public company in the market. So I remember when I conceived with the team the idea of, let's get right down to it. Let's discuss IPOs versus SPACs versus at the markets versus registered directs. So we put together a panel that's going to answer all of those questions. And it's going to be led by Anna Adelstein of PULLP.
Good afternoon, everyone. I am Anna Adelstein of PULLP, formerly Phillips & Uretsky. And I am a litigator who specializes in securities litigation in the microcap space. But today, we're going to be talking about something I don't normally get involved in until it goes sour, and that is taking companies public. IPOs, SPACs, reverse mergers, trends in the industry right now, and what choice is right for you. With me are 4 very highly qualified attorneys who have decades of a collective experience in corporate and securities law, capital markets, and financing transactions. Lynne Bolduc is a partner at Fitzgerald Creditor Bolduc and Risborough, with offices in California. Nazia Khan is an associate from Sheppard Mullin in DC. Andrea Cataneo is a partner at Mitchell, Silberg, and Knupp in New York. And Alixe Cormick is an owner with Venture Law Corporation from Vancouver, Canada. So, Lynne, will you kick off our discussion today by describing the current state of the traditional IPO market and what that means for microcap and small cap companies?
Thank you, Anna. I've been representing small companies in their IPOs since about 1996. The process really hasn't changed all that much while the market has gone up and down. I'm first going to briefly discuss some of the basics and then move on to the current market conditions and challenges. An IPO regular way is a public offering of securities with an underwriter with a listing of those securities on a stock exchange. A regular way IPO is still the most prevalent way to go public today. There are 2 types of IPOs, a best efforts and a firm commitment. A best efforts IPO, you get what you get. The underwriter will use their best efforts to place your securities directly with investors. A firm commitment is considered to be a bit better because the underwriter will pre-sell, so to speak, a company's securities, and then will purchase the securities directly from the company and resell them. A lot of people are confused by a firm commitment. It is not a guarantee. Changes will happen during the process based upon market conditions. Something else that's often confusing for companies is an engagement agreement is not an underwriting agreement. An engagement agreement is an agreement between the company and the underwriter for the underwriter to conduct 1 or more private or public offerings. The underwriting agreement is what you sign immediately before you go effective, whereby the underwriter agrees to purchase the securities. It doesn't come till the end. I've had clients believe that the engagement agreement guaranteed them that the underwriter would raise that amount of money for them. That is not the case. Companies are often confused about bridge financings as well. A bridge financing is a private offering of securities to raise a bit of capital for the company so it can see its way through the process for its expenses. Bridge financing is not guaranteed, even if it is in your engagement agreement. A bridge financing also may take the form of convertible debt that is convertible into the securities of the IPO at a discount. Debt can be an issue because it counts against shareholders' equity for the stock exchange requirements. As you all know, the stock market has been extremely volatile over the last 18 months. But experts are now saying that the IPO window is opening after the IPO winter. Regardless, a company needs to be flexible during the process. Once you've filed your documents with the SEC, before you launch the IPO, which is called going effective, the underwriter will assess market conditions and the potential appetite for the company's shares. The underwriter may ask the company to go through some gyrations during this process. Some of the gyrations that we have seen are adding one or more warrants as a sweetener to entice investors to the deal, a reverse stock split for valuation purposes, divesting of a CEO's shares or otherwise registration of selling shareholders for stock exchange purposes to meet their requirements, decreasing the offering amount often comes as a shock to people. I have this engagement agreement. It says the underwriter's going to raise $15 million. Why is the underwriter now saying $8 million? Because of market conditions. And lowering the price per share. When you file with the SEC, there's a range for the price, and often things lately have been tending to go towards the lower side of the range. As you move through the process, remember the goal is to get there. Once you are a public company, you will have options and you will have currency in the form of stock. There's been some stock exchange challenges lately. Nearly all small companies list their securities either on NASDAQ or the NYSE American. Both exchanges had a giant policy shift last year due to some wide swings in the trading price immediately after the IPO. So both exchanges now have a policy that they're going to review the proposed distribution, meaning how the underwriter is going to sell the shares, prior to allowing the listing. NASDAQ has gone full force with this, while the NYSE American has not. So we are seeing some of our companies choose to list on the NYSE American rather than NASDAQ recently. NASDAQ requires $15 million of free trading public float, meaning non-affiliated shares. Typically, offerings will come out at $15 million, but then if they're cut back to, say, $10 million, well, now you only have $10 million of market float. You're not going to meet the requirement for the listing. So we have to come up with $5 million worth of freely tradable shares. That's the reason for some of these selling shareholder registrations now being included with the IPO for the primary offering. NASDAQ requires 300 shareholders. The NYSE American requires 400. That's a lot of shareholders. You don't always raise money from that number of shareholders. All of that being considered, an IPO regular way on a firm commitment basis is still considered to be the holy grail to go public for small companies. And that's because no one knows market conditions in real time better than the underwriters. They will guide the company through the best time to launch the IPO. Number two, the underwriter does all the work of selling your securities for you. And number three, the company and the underwriter's interests are aligned. They both want to get the deal done. So my advice for companies seeking an IPO regular way are, one, money. Have enough money to get through the process. It can take several months. Not only does the company need to pay its regular expenses, but you'll have increased expenses during the IPO process. Number two, have some shareholders. Help out the underwriters. If you have some shareholders that you can register or just meet the requirement for the exchanges, that will be helpful. Number three, be flexible. When the underwriter calls you up and says, hey, we need you to do a reverse stock split, well, that's what we need to do. And number four, be prepared. Having your books and records in order and having a plan prior to going public will save you time. It will save you money. If you want to go public, the process started yesterday, not tomorrow.
Thank you, Lynne. So Nazia, I'm going to flip over to you. Lynne mentioned that IPOs can be very expensive. What kind of trends are you seeing with the traditional IPOs, and are there any other options that might be less expensive that you're leaning towards?
Yeah, so can't say there are necessarily less expensive options to your traditional IPOs, but what we've seen and what we're starting to see recently, especially in the life sciences industries, is more emphasis on M&A transactions. I'm sure you guys saw in the market last year, a lot of companies were struggling to maintain listing requirements. Specifically, we saw a lot of companies that were struggling to maintain their $1 bid price, and because of the number of new retail investors in the market, they weren't able to get sufficient votes, for example, at a normal stockholder meeting, to be able to do a reverse stock split to try to maintain this bid price requirement. And so what we saw last year was, preferred shareholders coming in. You sell a class of series preferred to one or a small number of investors that had the right to vote on a super voting majority basis, specifically for a reverse stock split. And then that share or those shares of preferred stock were then redeemed after the meeting was over. And basically, while that was a temporary relief in that a company could actually conduct the reverse stock split, what we saw in the aftermarket 4 or 5, 6 months later was the bid price still wasn't holding up. And so now you have all of these companies that may have done, a significant reverse stock split, one for 25, one for 50, and there's generally not so much more room to continue to do another reverse stock split to maintain your listing requirements. And so what we're seeing now, especially in the life sciences industry, is M&A transactions. You have all of these companies that need, a substantial amount of capital to conduct their clinical trials, to create and develop their product pipelines, but there's not sufficient money in the market for them to be able to do so. And so what we're seeing now is private companies that would want to go public, but obviously can't through traditional IPO methods because the markets are just not as great now, merging into these public companies. And while that is an alternative, and some of the advantages are that you have a valuation at announcement rather than having the market volatility and having to wait to see where the price lands. It's also flexible structuring because you can do it with cash as well as common stock. Not as beneficial for some of these companies that have their assets undervalued, but it is a mechanism for them to try to get out. The other advantage of doing this is that generally the timeline for an M&A deal is a little bit shorter. You're looking potentially around the 3 months compared to the 4 to 6 in the traditional IPO, but even that could be longer in this market. And then we're seeing a lot of cross-border deals that are happening. So you've got UK-based private companies coming in, doing these M&A deals. To a certain extent, we're seeing that some of them are on a tax-free basis, but not all of them. But even then, these transactions, they're still subject to valuation, which may not be great in this market, but that's kind of the alternatives that we're seeing with respect to M&As, generally kind of being an alternative route for companies that otherwise can't raise capital in the traditional markets.
Thank you, Nazia. So, Andrea, what are you observing in the capital market space, and are you seeing a rise in these type of acquisitions, and similarly to Nazia?
I'm actually seeing a lot of interesting things, but before I begin, I just want to, for a moment, edify and congratulate Shelley, Robert, and Lulu for putting on such a wonderful event. This is, I think, going to be the best ever, and I think it's going to be 30% bigger than last year, so well done. I am seeing our IPOs that are in process taking a lot longer than those in 2021, early 2022, and many of the prior panelists, and Lynne also spoke about bridges to IPOs, which we're seeing more of, and we're also seeing more expensive bridges, which is a little taxing on our clients, but unfortunately, what is available in the capital markets to microcap companies is what it is. We're always searching for other options. And as someone who has been in the space for 25 years, I try whenever I can to, introduce my clients to alternative sources of capital when I can, or some that might be able to give a leg up in the process. But what I'm really seeing a resurgence of are reverse mergers. And I made a little LinkedIn post that was an excerpt of something I wrote about for Shelley's magazine, looking at some of the statistics. And I think the title of the post was, are reverse mergers back? And there were a few people who immediately chimed in and said, oh, they never went anywhere. We never stopped doing them. But I really am seeing a resurgence of, at least once or twice a week, no exaggeration, a former client or a new prospective client is calling about what their options might be to take that shortcut to going public without exploring the IPO, unfortunately, which I agree with Lynne is the cleanest way to go for so many reasons. Without exploring the direct listing, which I'm a big fan of. If a company is patient, in 6 months, they can go through the process directly even without an underwriter, but these companies are looking for capital, and the reverse merger is attractive because for so many reasons, if done right, it gives a private company access to the transparency and the liquidity that most investors want, right? That's kind of what everyone wants when they are looking at, well, what are the advantages of being public? The problems are many, and I don't know, by show of hands, has anyone here gone through a reverse merger? But a handful. So it might have been a private company into an OTC markets company. It might have been you're counting a SPAC, which is also a reverse merger. It might have been a NASDAQ company that has gone delinquent. And that number, 13 to 14% of NASDAQ-listed companies are delinquent. So they're sort of ripe for a business combination or some M&A. In that respect, if we're looking at that as a category, as a potential place for a private company to browse for a going public opportunity, ways that, I caution my clients when we're looking at that as an option is to really understand how much equity they're likely going to be giving up for that shortcut to be a NASDAQ-listed company, when if they were only just a little more patient, maybe 3 to 4 months, they could keep the lion's share of their stock in an IPO, or even in a direct listing where they raise capital privately, follow the securities laws, file a registration statement, perhaps do a financing either before and register those shares or after a Form 10 and register shares, and then go through the 15C to 11 process and uplist when they're ready. That not theoretically, that can be done in 6 months if a company has their financial statements audited, and it's the least expensive. But back to reverse mergers, the challenge with the reverse merger into the OTC markets shell, which is sometimes most attractive, and I say unfortunately no disrespect to the OTC markets entities, but what often happens with an issuer that's excited about that as an opportunity is something has presented itself that it's such a great deal, they can't pass it up. Like, it's only $100,000, it's only $250,000 to get into this public company. And the issuer may not have taken the time to do proper due diligence. And these companies that have been public for a while sometimes have hair. Sometimes they have undisclosed liabilities. And often, a simple thing like having an attorney take a look at, well, have they ever been reporting? Have they failed to file? This I've seen more than a handful of times. A shell is on OTC markets, used to report, and 5 years ago when they ceased reporting, they failed to file a Form 15 to withdraw from reporting while they're current. That's the only way Form 15 works if you want to alleviate the responsibility of reporting and not have to make up those filings if you come back to life and become reporting again. The sad reality is if a private company merged into a bargain shell that went about their ceasing of reporting without following the rules, it might cost this company hundreds of thousands of dollars, no exaggeration, to make up all of those missed filings. And the SEC is not wavering on that. They're not. The only, I guess, mitigation that I have been able to convince the SEC to just make it a little more feasible for a client to utilize this entity that they're in is they'll permit sort of super filing, like a 10K that has so many of the disclosures of all of the missing Qs and Ks and so on. But it's a nightmare. Imagine going through that process of paying some money or not. You know, sometimes it's an all-equity deal, but a company has given up significant equity and they haven't consulted counsel to check some of the 10 or 15 things that I think we would all have on our checklists. I guess a final comment on reverse mergers is it's really an ounce of prevention is worth a pound of cure. And it's like that, I think, in so many of securities legal issues. Blue sky, for example, there are just many, many things that, if done correctly the first time, you save a fortune later on. You can wind up with a very, very expensive mistake later. I think direct listings is just worth another plug. I don't think we spoke much about that. Some of the prior panelists maybe brought up that possibility of that as an alternative. I encourage those of you who are private companies and exploring ways to go public that you consider that as an alternative. If you have your financial statements audited, you just need a team around you that can get you through the process, and you'll preserve an awful lot of equity as opposed to some of these other methods.
Thank you so much, Andrea. So Alixe, you practice in Canada.
Yep.
What are the trends up in Canada, and are you seeing cross-listing going on? Are there any opportunities for companies to do that?
Okay, let's talk about the market. So what I've seen, first of all, I've been practicing law for almost 30 years, probably is 30 years if I think about it. And I've done over 200 IPOs and public listings of RTOs, whatever, however people want to go public, I'll do it. And I've probably acquired and sold over 600 companies. So when you start seeing deal flow like that, one, you see trends, they come and go. One, oftentimes there's never anything new, it's just been kind of reformed in some way, shape, or form. Here in Canada, first let's remember our size. So first quarter, true IPOs, I would say let's leave out ETFs, let's leave out SPACs, let's leave out funds or funds of funds or royalty deals, but I am going to talk about one royalty deal. In Q1, we had 21 companies do IPOs in Canada, true companies doing IPOs. On the TSX Venture Exchange, they had 11. All 11 were CPCs. Guess what CPCs are? They're like mini blank check companies. And their whole purpose is to do reverse mergers, or what we call a qualifying transaction that has rules and parameters around it. So it's not the same type of thing that you do down here. We do have kind of more rigid rules in terms of what you can do and what you can't do, and what the principals in the company are able to do and not do. On the CSE, they had 30 listings, of which 8 were IPOs. 30 listings in this last quarter, only 8 were IPOs. The number one way that people go public on the CSE is by direct listings. And oftentimes a broker-dealer is involved beforehand, where they'll either do a special warrant deal or they'll do receipts, and those things automatically convert as part of the prospectus. We file a non-offering prospectus to clear those securities and become a reporting issuer. And then they just put a wrapper around it. So you basically have kind of an index that says, this is what the listing statement requires, this is where you're going to find all that stuff. For kind of the other exchanges, the TSX had one listing, and that listing was a royalty deal, and it raised $150 million. So out of all the IPOs that were done in Canada in this past quarter, they raised about combined $178 million, of which one represented $150 million. We had one Canadian company list on NASDAQ, that was Lucy Scientific, and they raised $5.8 million. So, and we're talking Canadian dollars, So back it up about 25%, and you have an idea of how small our market is. But, you know, having said that, Canadians, one, particularly where I'm from in British Columbia, we're not risk adverse. We look at kind of deals as being people, particularly early stage companies. The people are the most important part. Every single life science company I've taken public has pivoted, every single one. And a lot of them have listed on NASDAQ, New York Stock Exchange. You think you've got a heart drug, and you find out you got Viagra. You think you have something that's going to, you know, help children with cancer, and you find out it grows hair. Like the things, one of my non-go public client, they were one of the largest sales that we had out of Vancouver, but what they were aiming for is helping children with eye problems. In this room here, there's probably 20% of you that have Botox in you, and that came from Vancouver. So everything
Why are
that...
you looking at me?
No, I'm not looking at you. So, you know, everything that we think we know about companies, you're talking about betting on teams and people. And when you have good people, you're going to ride that horse. And maybe you think you're going here, but you may be going to a different destination. And I think sometimes regulators forget that. But in kind of looking at the trends, we're moving away from an IPO market, moving to one where we have certainty. We were talking as a panel group the other week, I guess it was, and I always look at the VIX as a starting point. So VIX is the volatility index. Some people call it the fear index. So when VIX is sitting around 12, we have what we consider stable markets, and we have more IPOs because people can price. When VIX moves into the upper teens, definitely when it hits over 20, think of certain events that we've had where it's even gone as high as 30, 35. There are no IPOs, or IPOs are less likely to happen. When they're talking about windows, when VIX is occurring, we're talking windows between 12 and 17, where we're sitting today, I think is at 17. But there's other factors. So we have things like, you know, I'm part of the dot-com era, where we had kind of a really shitty year just before that occurred. Sorry, hopefully no one's PG offended. But we had a bad year, and we were thinking it's going to come back. And then, of course, 9/11 happened. And so we didn't have any IPOs until February the following year. Sometimes we have kind of war, or we have collapse, bank collapse, and other types of things. 2008 wasn't that great, but it was great for mining companies. So anytime we have volatility, someone's benefiting in the market in some way, shape, or form. I think the reason why in Canada in particular, direct offerings, RTOs are favorable and have always been somewhat favorable is they provide the issuers with certainty that you don't have. So when you're putting your hands in an underwriter, you basically are kind of looking at the market and you're looking for those windows and being able to price. We had a situation where I would say in 2021, a little bit back up a little bit before kind of the COVID shutdowns, where we had kind of a very frothy market where things were being priced over market value, where they weren't getting corrected. And there were some incentives in the marketplace for that. So what we've had now is kind of a little bit of a correction, but we've also had you know, a sobering up of kind of high interest rates, inflationary kind of things going on over the place where people are impacted, the kind of a hangover from the lockdowns. And we also have this uncertainty of what's going to happen next. And I think that's put a little bit of pale. So I think we have to look at kind of where are we going from here. I don't think this year's going to be a great year, not for IPOs. We have a lot of kind of pent up worldwide of people that want to go public. In Asia, there's over 800 companies that basically have been sitting on the shelf and they're looking to go public. Here in North America, last year, most companies on the larger deal size shelved themselves just because the pricing was wrong. If you take a look at kind of where did companies that did IPO favor, true companies, not again, if you're a fund, you just got money in the bank and it's not going anywhere, but true operating companies, majority are trading below their IPO price and some of them quite significantly. It didn't do them any favors. And like Nadia was talking earlier, once you're stuck in that position of kind of, I got to do my listing, I can't get any more new money at these prices, or I don't want to dilute myself, where do you go? And you have kind of a few options. One is to reverse merger, but anyone who's done a reverse merger knows that your stock drifts back down and settles down, particularly if there isn't any new information, or you can't do that raise. So I don't know, where do we leave it from there? I thought we were going to have more of a conversation. Would love you guys to start talking to us and asking your questions, and would love to have kind of conversation in amongst the panel members here.
Sure. I guess one question I had is, you've all been talking about the market and the defining factors in the market and the volatility, but when you're making a decision of what type of route to take, whether you're doing a merger or an IPO, is it company specific or is it market specific? Is it based on company needs? Or is it different every time, or is it based on what's going on in the industry?
I can start, but I think we all have something to say about this, because it really does depend. If a company is operating and has financial statements audited, then all of the options are available. If it's early stage, it's foolish for the company to IPO. It just doesn't make sense. And it's also foolish to go public too quickly. It's not the panacea. It's not, oh my God, if I have a symbol, I'll be able to get money. It doesn't work that way. If you don't have the fundamentals and a company that is really ready to report, ready to talk about their officers and directors in a way that supports a business model and that has a business that has a future, it's really, it's a waste of time and money, because the market is going to recognize soon that the company's not ready. And unfortunately, the only capital that's going to become available, I hate to use the word toxic because I don't mean to insult anyone, but there are funding sources that are very expensive and are extraordinarily harmful to a company's stability, and with a volume-weighted average price discount, with high original issue discounts. It's very expensive money. And these small early-stage companies that decide to go public too quickly sometimes never recover from that. And it's a shame, because had they waited, they would be in a better position to access capital that's not as expensive. But really, with respect to, if you have the bare essentials, you've got a company with good business fundamentals, strong management, good board of directors, audited financial statements. Looking at an IPO for the reasons that Lynne articulated, that might be the best way to go. Or if there's a NASDAQ entity that's available that is willing to give up a lion's share of equity, or if there's a synergistic business where these companies can actually do something together, that might be the way to go. It really has to be something that is discussed with the client. It's not one answer fits all.
I start by asking why you want to go public. So we've had clients, or I've had clients that are maybe from Europe or from Hong Kong or South Korea, for instance. I've taken a lot of South Korean companies public. Why do they want to go public in North America? None of them want to be here. They want to go back home, but they couldn't list back home, because for Koreans and South Koreans, the government gets to decide. So if a government has a company that they're taking from the private and going to the public, to the markets, and your company does something that would compete with that pool of investors, they're going to shelve you. But if you go public in North America or Europe or someplace, you become number one to go public in your own market. Their market's like a lottery. So if it's $1 over here, theirs will go to $1,000, sort of thing, quite quickly. Another company, they're a large tech company. They went public out of France. They didn't care if they traded here. Why did they do it? Couldn't do government contracts. What people forget is you can't do certain government contracts unless you're a public company. It doesn't matter what the market's doing. You just need to be a public company. We take companies public early in Canada, in part because we don't have a big, deep venture capital market. We don't have a very deep PE group. Biotech companies in particular don't get much love in Canada, neither do tech companies. However, you take a look at kind of like where they are, what they can do, and you try to counsel them. Unfortunately, some legal counsel, one size fits all. It's kind of like Cinderella. I'm going to cut your toes off. I'm going to basically cut some bone if I have to, and I'm going to get you to fit into that shoe.
That's not the version of Cinderella.
Well, apparently I'm one of the ugly stepsisters that basically will do anything to get myself into the shoe. But, you want to kind of look and see what is going to be the best for that particular client. Why do they want to do it? Sometimes it's because they've got a company and maybe it was owned by a family and some of the kids don't want to take it over, but it's viable. It goes public. So we've had that for a number of different large private held companies in Canada that have done that. Anyway, so that's where I start.
I wanted to make a comment on the reverse mergers that Andrea was talking about. Another trend that we're seeing recently is, back in the day, all reverse mergers were into OTC companies. Now I'm seeing reverse mergers into NASDAQ companies, which is a whole nother ball game and a much better ball game to be in.
Absolutely, and that's why I brought up the fact that 13% of these delinquent NASDAQ-listed companies are really good candidates. So when someone calls and says, hey, do you got a NASDAQ shell? Do you know of a NASDAQ shell? And our response is, well, there's really no such thing as a NASDAQ shell, but I know what you mean. You're looking for, a delinquent or a deficiency letter, a NASDAQ company that's received a deficiency
we call them
letter.
legacy
Right.
vehicles.
Yeah, that is ready for maybe a transaction. And it's certainly a better path than the OTC Super 8K difficulty, and then having to season and wait sometimes 6 months or a year to be eligible for listing.
I think we have some questions in the audience. I see hands, and we have just enough time.
Well, you're standing there. I know you're a litigator, and I'm curious as to whether or not there's been an increase in litigation in the last 18 months. And
Really quick plug, she just won a really big case.
Yeah,
Hear,
something to do
hear.
with preferred shares. But
So-
yeah, there's definitely an increase in SEC litigation coming down around those types of toxic debt financing, not to call it that. I mean, that's not what they call it, but yeah. So I think what I'm sensing is a lot of that might be avoidable if companies are planning ahead of time, getting ahead of it, maybe starting to think about these things on an earlier time frame. I know that these companies are not able to go to your regular bank, walk into Chase and get money, so they have to get it somewhere. It's a need that's being met with money, and I don't know what the SEC is going to eventually do. But I think we'll know more in the next 6 months to a year as to what's going to be the future of that convertible debt feature and whether or not companies can continue to use it. Thank you, Shelley.
For those of you who have helped issuers file a direct listing, what has been your experience and success for the issuers in creating a public market once they're actually public?
I was looking for who's asking that question.
Greg Kearney in the front.
So,
okay.
oh my God. Okay,
Yeah, I was going to say, he's sitting right in front of you. Sorry. I would say, it really depends on the company. I have a conversation with them. Stock doesn't sell itself. People aren't sitting there waiting for you to appear. They're not looking for you. It's kind of like, it's like you wanting to date someone or marry someone, and you sit at home all day and thinking that the perfect wife is going to show up. She's not showing up. It's not Dial-A-Bride. So you got to go out there and you got to meet people, and you have to have a plan. So I tell people, first and foremost, if you're not going to have an IR program, your stock is not going to sell. And you have to have a compliant IR program. You can't do just random promotion out there with all sorts of material reps. So I tell people the starting point really is to figure out kind of like the IR program that you're going to do, putting out regular information, but also looking at your market. I was taken aback one time where I did a deal, and I had told them they had to get their IR market, and then we were looking to do an acquisition about 8 months later, and we filed an S1. And when we first originally did the deal, we had 300 shareholders. When 8 months later, we had 7,800 shareholders, and I went, how the heck did that happen? It scared the bejesus out of me, to be honest with you. But the stock didn't have any wild swings or anything like that, because I looked at it during that period to see what they'd done. And he said, well, I took to heart what you said, and I went and talked to every fund manager I knew, or my brother knew, or anyone else that I could talk to, and I went to every investor show, a show like this, to just talk to people. I took someone to Shelley's show 4 years ago that was listed on the CSE, and we were doing a Reg A1 crowdfunding. On that, we ended up with about 3,000 new shareholders from that program, but just by attending this conference, their stock went from 5 cents to 70 cents by the time we closed that thing. And part of it was just, it started here because you could see it, so people got interested in the company and they started buying it. He didn't get any set sales here in terms of people buying in, but where he got the sales or the buy-in was in the market.
I'm glad you brought up Reg A, because that's what I was thinking we failed to mention, and probably intentionally. That wasn't on our short list of, what are the alternatives that companies are looking for in this discussion. But certainly that is a way. Any general solicitation offering is a nice way of building a shareholder base, which if you're doing a direct listing, you really need. Lynne brought up before the fact that NASDAQ now wants to know weeks before a pricing information about shareholders. It's not like it used to be, where the night before the retail investors could come up with the list and all was well. I mean, they want due diligence done. They want to, know their customers. They want to have a little bit of access to information on the shareholders. So that's critical. In a Reg A, where you're getting, your prospectus and information supplement qualified by the SEC, there's an opportunity for, gathering shareholder information. But with respect to a regular old direct listing, where you're just raising money from friends and family, maybe up to 50 or so people, you've got that data. You've got that information that you typically gather on a subscription agreement. And 50 is all you need if you want to have a market maker file or submit an application for a 15C211 to be accepted to trade, to get a symbol, et cetera. If you could get 300, fantastic. But getting that 50, registering those underlying shares if it's a convertible instrument, or registering the shares if you're selling securities, will get you that shareholder base of known shareholders, and then carrying that process on to your question is really just a matter of making sure that the registration statement clears comments, coordinating efforts with OTC markets if that's going to be your first step of where you're going to trade, or better yet, if you're fortunate enough to do a broader offering where you can get 300 shareholders.
Yeah.
And you're a seasoned company that has all of those characteristics that I mentioned earlier that would otherwise qualify you to apply to list on New York Stock Exchange American or NASDAQ. How beautiful is that? You've just saved so much money in terms of comparing that to an IPO or an uplist or a reverse merger and an uplist, just by doing it organically and working your way up. But it's not so easy to have all those things fall into place.
Just wanted to mention that, to Andrea's point, I've had a good experience with getting Reg A pluses through the SEC quickly. The company can raise a small amount of money and acquire a shareholder base.
Yeah.
And it's sort of a good preliminary step for a company to get used to a lower reporting, audited financials, and all that.
Training wheels.
Well, right now it's taking about 70 days to clear through. So you can get a broker-dealer involved, and that broker-dealer, the reason why they like the direct listings, where they're actually placing in Canada, as I said, doing special warrants, so the company can't touch the cash until it's actually listed or the prospectus is cleared, but they've done the private placement beforehand, so the company knows it's got the cash to kind of go forward and do whatever it wants, but the broker-dealer doesn't sign the certificate on the prospectus. Same with Reg A. So unlike a traditional prospectus, an S1 or an F1, they don't sign the prospectus or not a prospectus, the offering document for Regulation A. So their liability is reduced. They still have FINRA requirements, and so don't get me wrong, there's still expense associated with that, but it actually reduces it. And when you finish doing a Reg A, you can elect to become a reporting issuer under the 1934 Act by filing a Form 8A. And so it has a number of different advantages. But really, that advertising piece, let's circle back to what you were talking about. How do you get investors interested and do that marketplace? I would say we need to take our cue from other people in kind of the regular kind of market selling widgets and other things. How do they find the group that likes them? It's kind of like if you're a cowboy and you go to a punk bar, chances are pretty good you're not going to walk out or have very good experiences there. So you're looking for where those experiences and where those people are looking for you.
Thanks.
Just a quick question, Andrea. I always thought that if you're going to do a reverse merger, you want to do it into a shell that the prior company was actually bankrupt,
Preferably.
so that you avoided any of the quote-unquote undisclosed liabilities.
Yes.
No skeletons in the closet, or at least the ones you know about.
Yes, and now I'm forgetting the section under the bankruptcy code. I used to know this so well. Section 14. Say it again? There's a section under the bankruptcy code that's really a beautiful thing that a lot of private companies are unaware of. And I'm not a bankruptcy attorney, I don't pretend to be, but it's the ability to create a class of free trading shares to pay off liabilities.
Yeah.
You could also use it to raise capital. Lots of companies, when they're going bankrupt, don't realize this particular section is available, and it's a shame because a judge will approve it, and then it can be part of the package. So yeah, a bankrupt company is ready for a fresh start, perhaps, and I don't know if you're talking about a Chapter 7 versus a Chapter 11, but in any event, it's a cleanish slate. And this way you don't have to be concerned about all of those skeletons, so to speak, because from that point forward, you've got a shareholder base and a clean slate. So good question. That's certainly something, to explore if a company is looking to do a reverse merger.
The SEC has a clause that essentially says any court-ordered issuance of shares is free trading. And so that applies if you were doing, let's say, you were doing a merger or an acquisition in Canada. You could do a plan of arrangement which requires a court order, so those shares would also be freely tradable in the United States. And it also has a couple of other kind of advantages for you as well for more complicated deals, whether you're doing kind of exchangeable shares or some other kind of more tax-induced structure.
We have one, oh, sorry.
I was going to say, that's interesting that you bring that up. We had a couple of plan of arrangements in Canada, and they got a court order in Canada, but then those companies struggled to have that recognized in the U.S. And so what we ran into was having blue sky registration issues across the various states in completing that transaction. So from that perspective, while you can do it and, it is doable cross-border, it's not necessarily as easy to have it recognized in the United States, especially if you're going to be doing it in Canada.
What we do is we'll try to involve a court action in both jurisdictions.
Mm-hmm.
Thank you.
Sorry.
Yep.
We have
You can
time
say
for
that.
one more
No,
question
I think
over
that's
here.
Amazing.
In the transactions you've done in the U.S., what would you say the implied valuation of a public shell is for an OTC company, clean public shell? What value are they sort of receiving post-transaction?
The only reason I can answer this quickly is in the last few months I've been looking for prospective clients, and it really ranges. There are all equity deals, and they're often owned by investment bankers who are looking for a company generating a lot of revenues and that has good fundamentals, all the way to $750,000, which is at the rate where it used to be in 2005, 2006. Lynne and I remember those days when there were, I remember this guy, Michael Queel, he had a company and he charged $1 million for the shell and for some services that wrapped around the transaction. So it's getting up there. If the shareholder base is bigger, if it's a Delaware or a Nevada corporation, if it has no liabilities and it's clean, there are a lot of things that companies are looking for specifically that they believe would make it more valuable. So there tends to be a range that big. I think most of them, if you were to look, and I have some contacts that have been in the business for years, 250,000 to about 700,000 seems to be, the basic range that I'm seeing.
Thank you all so much for coming today. We are out of time. If you want to reach out to any of these very qualified attorneys, you're thinking about going public or you want to be involved in one of these transactions, where can they contact you? You want to give your emails or your website, or it may be available on the Planet MicroCap site, so
On the MicroCap.
you can look there.
Come visit us at our booths.
I was going to say the
perfect.
same thing. I
I
think
look
we
forward
all
to
have a
seeing all of
booth.
you.